Good day, grade 12. Welcome to my channel. My name is Tembela Skolo. I'll be taking you through the income statement. This question paper is taken from the Limpopo March 2023 paper. So let's get into it without wasting any time. Looking at whenever you are asked to do income statement, remember the first thing that we know as students is that we'll be given our pre-adjustmental balance. What to look for on a pre-adjustmental balance? You need to make sure that you know your year end. By the looks of things here, we are dealing with Maleka Ltd. The books of Maleka Ltd. The information below relates to Maleka Ltd, the financial year ended on 28 February 2022. Okay, so we are dealing with a business that had a financial year ending on February 2022. So now you know when your year is ending. Okay, so we are saying complete the statement of comprehensive income, which is the income statement for this current year. Okay, so they are asking us to prepare the income statement in other words. Okay, so now we are given the information. You know that when you are doing the income statement, you always start with your sales, then you subtract your debtors allowance on your pre-adjustment, yeah, to make the total turnover, which means the sales. Then what we are going to do now to make up our turnover, then after doing that, you check for additional information. So we are going to go straight to our answer book. Okay, so 8,800,000 is already there, so we don't need, you open bracket, you put that 8,800, 8,800,000. Then you subtract, what are we doing? We subtract the what? The debtors allowance, which was 19,200 rands. $19,200. Okay. Then again, we check for additional information. If there's no transaction that will affect our sales. Okay, what do I mean by that? I will check whether there is no transaction that took place or there's no sales transaction that took place without being recorded. Okay, if there's a transaction that took place, there's a sale transaction that took place, which means we have sold some stock to a certain customer without recording it or after our books have been done. So it was not recorded, so we will have to add that sale because now our sales are increasing. Okay, again, we check whether there's no customer that has returned stock to the business. So we check also that if there's a customer that has returned stock to the business, that means our sales now will decrease. Remember, he's returning the stock that we have previously sold. So now if that person is returning that stock, that means our sales will decrease. Okay, we check for transaction of that nature as well as for errors. Remember, when you are dealing with books of the business, because you are a human being, you are liable to make mistakes. So there may be errors that the bookkeeper may have done. So we will check those errors. Whether the bookkeeper made any error. So we will check for those errors as well. So what will happen is that now, looking at our adjustment, we have adjustment number A. In adjustment A, the business price, it's goods at a markup of 60% on cost, trade discount of 360 was allowed on invoice to certain customers. Now, this discount, this is a discount allowed. So now the business prices its good at a markup of 60% on customers. Trade discount of 360 was allowed on invoice. Remember, there's nothing saying that this was not recorded. Ne? But we are just being told that there was a trade discount that was allowed. I hope we are together. So if this trade discount that, and remember, what is a trade discount? This is not just a discount to an ordinary car, but this is a trade discount. When we speak of a trade discount, we are giving that person a discount when he's buying the product, because maybe he's a loyal customer to the business. So we are granting that person a discount. It's not a discount that you qualify for. There are those type of discount that a customer can qualify. Should the customer pay early, or should the customer? So there are those types of discount. But now we are speaking of the trade discount. The trade discount, because you are a loyal customer to us, so we are giving you a discount. So which means on the sales, on your sales, we will decrease this amount. So that's one thing that we as students we need to understand when we are dealing with a trade discount. Okay, now let's go to this now. Oh, remember, this won't affect the sales. Why? It's not affecting the current sales because it has been recorded already. When we were doing, remember, when you are taking sales, you take sales from your CRJ and you take sales from your what? The sales of the total sales from your DJ, because these are the two journals which we will see sales. And in those journals, in both of those journals, you have a what? A column for what? For each discount allowed. Yeah. So now the moment that you do this journal, you include your discount allowed. So now the total that you will take, it will you will have also included the discount, or you will have, when you are calculating the sales figure, you will have subtracted the discount. So whenever you are doing your CRJ, you subtract the discount on the column for sales, and whenever you are doing the DJ, you subtract the discount on the column for sales. Okay, so I hope, guys, that's clear. Then that's the reason that I won't use this 360,000. But remember, you will never be given any figure if there will be no need for it. So maybe we'll use this in the near future. Let's move on and check for another transaction that will affect our sales. This one is not affecting the sales yet. Okay. A trade note for 49,600 issued to a debtor dated 25 February 2022 was recorded as an invoice. Now, remember what happened here. This is an error, guys. Remember, now we had sales. We have the sales account. We have also the debtors allowance account. Debtors allowance account. I hope you remember this account, good people. We had these two, the debtors allowance account. So we have these two accounts. Remember, there's a mechanism that I normally use, which I call ADC. Okay, hope it doesn't matter, because now we are not dealing with let's not deal with it in a form of an account. Yeah? Okay, now when sales are taking place, which means if we are selling something, that means our sales will increase. Are we together? We have remember, any transaction, if the transaction is affecting the sales, it's either it's increasing the sale or it's decreasing the sales. Also, if we have debtors allowance, debtors allowance, it's an opposite account to the sales. Are we together? What is the debtors allowance? The debtors allowance will always decrease the what? The sales. If the debtors allowance are increasing, that means the sales are decreasing. Are we together? So we have that debtors allowance. So the debtors allowance, okay. What is a debtors allowance? The debtors allowance will record the returns by the customer, by the debtor, in fact. If the debtor is returning stock to the business, so we'll record it on the debtors allowance journal or on the debtors allowance account. Are we together? And also if an approved debtors allowance as well, but we won't go into that. Now, a trade note of 49,000 issued to a debtor. Remember, when we are issuing a trade note, this is a source document the business issued, because Now there's a data. There's a what? There's the business. So there's a transaction that take place, maybe a trading stock that is being sold. Trading stock that is being sold to the what? To the debtor. Now, in order for us to sell a trading stock to the person to be a debtor, that means that trading stock have been sold on credit. So it's accompanied by the what? By an invoice. So whenever we are selling anything on credit, then the business will issue out an invoice. I hope you still remember that. Okay. Now, what happens if the customer decides to return the stock? So now, should the customer return the stock? So, which means the business again will have to issue another source document, which is called now a credit note. A credit note. So when we are doing bank reconciliation statement, when we are doing the bank reconciliation and the debtors reconciliation, creditors reconciliation, I will explain all of these guys. Yeah? Okay. Now let's go to it. Now we are saying now a credit note, it's a source document that is issued when someone is returning stock. So this means by the looks of things, if we have issued a credit note, that means this person was returning the stock worth 49,600. But what we did as a business, we recorded that trading stock as an invoice, which was an error, guys. So which means what we did, we added it on our sales instead of subtracting it. So we added it on our sales. We added the 49,600 on our sales, which means in this amount that you see over here of the sale, included in that amount is the 49,000 that was not supposed to be there in the first place. So we have to subtract it to take it out because it was not supposed to be there in the first place, the 49,600. Then we do the correct thing that we were supposed to do. Remember, I said that debtors allowance will always affect the what? The sales negative when someone is returning stock. So the correct recording that we were supposed to do was to subtract the 49,600. Okay, now by joinery, we have subtracted the 49,600. We have to subtract the 49,600 twice. So that's where that principle comes in. That states that, okay, if there has been an incorrect recording on a wrong site or on the wrong journal, so now you need to correct that by that error. How do we correct that error? You will record that amount on the correct journal or on the correct site twice. So that means now we will correct that error by doubling that figure. So we will subtract it double now. The 49,600. So 49,600 multiplied by 2 will give us 99,000 and something. Sorry, okay, let me use this calculator over here. Let me open my calculator, guys, so that we use the same. Okay, using my calculator. Then you go to your calculator, you press your, it's 49,600 multiplied by what? By 2, which will give us what? 90, which will give us 99,200. So you write your 99,000 over there. Oh, sorry. I think next time I will use the calculator that I have on the hand because okay, so we subtract the 99,200 rands. Okay, so we check for, is there any other adjustment that will affect our sales? Adjustment C, a debtor pay Marlene with outstanding balance 42,000 has left the country, so this is not affecting our sales. So D, it will, so normally if the next transaction is not affecting the sales, so that's normally you will know that all the other following transaction won't affect our sales as well. So that's something that is common about the transaction, the accounting guys. Okay, whenever we are dealing with accounting transaction, by now we have noted that. Okay, so this is the only transaction that was affecting our sales. Then you close your what? The bracket, you calculate the total turnover, which will be 8,800,000 minus 192,000, or 19,200 minus 99,200. Okay, I hope guys you are clear. Partner, we took the 8,800,000. We subtracted 8,800,000. Subtract the 19,200. Subtract the 99,200 again. Then you punch your calculator. We are getting 8,681,600. So we write that 8,681,600 over here. Okay. Then we move on to the cost accounting. Double check the answer. Yes, it's the same answer. So we move on to the cost of sales. Now, how are we going to calculate our cost of sales? So let's check whether are we given the cost of sales on our pre-adjustment trial balance? No, we are not given the cost of sales. There's a question mark over there. That means they are expecting us to use the information on the what additional information to calculate for the cost of sales. Okay, let's use our information. Then calculate our cost of sales. Which information they are expecting us to use the markup. So now remember transaction A, it was stated that the business prices its goods at a markup of 60%. So you will assume that this markup, when the transaction is like that, you will assume that this markup is the markup achieved. So how do we use the markup? Remember, whenever you are using the markup, you take your sales amount, you know the formulas, guys, that the sales amount will always be equal to 100 plus the markup percentage. Then the cost of sales will always be equal to 100%. So now, if this is the ratio or the proportional of our sales and cost of sales in terms of a what of a ratio, so it's always 100 plus markup, and the other one will be 100 plus markup. But there's something that you need to note when we are dealing with sales. This sales, this is the turnover. This is not the turnover, guys. Yeah? So the turnover is the amount of sales after we have subtracted everything. After we have subtracted the discount, after we have, okay, this is the sales. After we have subtracted the tax allowance. So this is the turnover. We are going to take it. Yeah? So this is the sales. But now there's another jigsaw puzzle of it that you need to understand as well. That when we are dealing with sales, in order for us to use this proportionality, you need to always take your sales, if there was A, and add back the what? Add back the discount, the what? Remember, the trading discount, not the discount allowed, but the trading discount. The trading discount. So this is the trading discount that you need to add back in order to get this figure of sales. Yeah? So you always have to add the trading discount, because when you take your sales and adding your trade discount, therefore they will be equal to 100 plus markup. So whenever you're having trade discount, when you are calculating your sales, first add the trading discount first, then calculate. Okay, what I mean, now in order for us to have the sales, remember, when we are looking for a cost of sales, that means our formula when we are looking for a cost of sales, we will take our sales, because now we had a trade discount in this context. We are going to take our sales and add our trading discount, our trade discount, not our trade discount, sorry, not our trading discount, our trade discount. After adding it, then multiplying it, we are looking for what? The one that we don't have, the unknown, which is 100. Out of the known, what do we know? We know the 100 plus markup, which our markup in this case is 60%, which is 160. 100 plus 60 is 160. So this is the formula that we are going to use. Let's go. Therefore, we are going to take the sales plus the trade discount. How much were our sales? It's 8,681,600. Then we add the trade discount, which was 360,000. Then you multiply with the percentage. You multiply, we are looking for what? 100 with the ratio out of 160. Whilst having 160, that will give us our cost of sales. So remember, we said we took the 8,681,600, and then we added, sorry, let me open my bracket first. I open brackets and said 8,681,600 plus I added back the 360,000, which was for a trade discount. Then I multiply with my 100 over 160. So that would give me what? 5 million. It's 5,651,000. Okay, so I made the mistakes. I'm sorry, there's a delay on my pen. Okay, so we are saying now we are having 5 million. 5,651,000. 5,651,000 rand, which is our cost of sales. We put it in brackets because we have to separate it. Then again, you take that 8,681,600. Then you subtract the 5,651,000. Then you'll be getting what? 3,030,600. 3,030,600. I hope it makes sure, guys. So then we are done with that part, the trading part of the business. So we move on to other operating income. It's nice because they have indicated for us that we are having a rent income and the provision for bad debt. Okay, so now we have to go straight to our rent income and see the figure from the rent income. We'll see it on your nominal account section on the trade side. So this is our rent income, which was 70,500. We go and put it there, 70,500. Then check whether there is any transaction with respect to a rent, any additional adjustment. So transaction number D, provision for bad debt, not rent. E, physical stock taking, not rent. F, one employee, which is wages, not rent. G, advertisement, not rent again. H, make provision for bad debt. for depreciation, not rent. Then we move to the next page and check for the further transaction. I, share capital, not rent again. T3, J, dividends, not rent. K, operating profit, not rent again. Maybe we might as well start with this one after we are done with our operating incomes, our other operating income. So please, I would like for us to deal with this one. Okay, so income tax, not rent again. So there's no transaction with respect to rent. So that means you will close your bracket and take your rent as it is, which will be 70,500. It's a relief for many of you. Then we move on to the provision for bad debt. Okay, now before we move on to the provision for bad debt, I would like to highlight something here with respect to provision for bad debt. So we will have to remember always that when we are dealing with provision for bad debt, we are looking actually for two things. We have to get our old, we are comparing two values, the old value of the provision for bad debt and the new value of the provision for bad debt. What are we really comparing? If the old value is greater than the new, that means we are having an income. Our provision for bad debt will be, that difference will be an income. The difference, we are looking for a difference. But if the new is less than the old, so if the new is greater, if the new is now greater than the old, the new provision for bad debt is greater than the old, then we are having an expense. This is what you need to know whenever you are dealing with bad debt. Okay, what do I mean by that? Remember, bad debts, guys, are an expense that it's an assumption of the business that we assume that we want to receive this money. We may write off this certain amount of money this year, or we may not receive this money from our debtors. So it's an expense, guys. So if the new expense is greater than the old one, which means there has been an increase in our expected expense. So that's why it will be an expense. If the new is less, that means there has been a decrease on our expense, which is positive for the business. So if the expenses are decreasing, that's an income for the business. If the expected expenses are decreasing, I hope it makes sure. Then let's move to it. So the first thing you do when you are doing, you always compare. You take your provision for bad debt, at the beginning of the year. So this is the provision for bad debt on your pre-adjustment trial, and this is the old provision for bad debt, the provision that we expected before the transaction. But during the year, we had a new provision for bad debt because of the operation of the business. And we are told here there's a transaction, which was transaction number D. The depreciation for the provision for bad debt must be adjusted to 5% of the outstanding debtors. So what do they mean about the outstanding debtors? They are meaning we must calculate provision for bad debt on the debtors that will be registered, on the debts that will be registered at the end of the accounting period, the debtors that we are having registered at that time. So the people that are on the amount that is being owned to us by our customers. So now how do you determine that? That means, in other words, we have to calculate first for the trade debtors. For the trade debtors, not someone that is owing us because of that person didn't pay rent, or because of that, but specifically for the people that are owing us because they have bought stock on us. So that's a trade debtor. So how do you get trade debtor? You always, this is a formula over here. You take your debtors control on your pre-adjustment, debtors control on your pre-adjustment, then you subtract your bad debts the new bad debts, in other words, bad debts on your adjustments. After subtracting the bad debts, then again, we move on to say, you check for any transaction that may have affected your debtors. If I remember carefully, there was this transaction over here, which is transaction number B. In transaction B, we were told that a trade note, remember, we take out a trade note when a debtor is returning stock of a debtor, and this transaction is affecting our debtors. So the only thing that we need to check is this transaction affecting our debtors positively or negative. That's what we need to check. So that means you need to analyze this transaction very well. Okay, now what is happening here? A trade note for 49,600 issued to a debtor dated 25 February was recorded as an invoice. Okay, so if you are recording, what does an invoice do? Remember, on our debtors control, you need to know the effect of an invoice on a debtors control. Debtors control, on a debtors control, the effect of an invoice, whenever there's an invoice, our debtors control will increase. So, but whenever there's a what? A trade note, which means the customer is returning the stock, our debtors control will decrease when there's a traded note. So now this means, guys, if our debtors control are increasing when there's an invoice, which means when the sales are taking place, our debtors are increasing. Okay, when we are selling on trading. So, but now this was an error. That means we previously added this amount. So now we need to do the correct thing, which was we were supposed to subtract it. So we previously added it on top of the debtors control. So now we are supposed, this error, we will subtract. Hence, I don't want to write it as a formula that the additional information you will subtract. It will depend, guys, on the transaction that you are dealing with at that specific moment. Okay, now, because of this transaction, now we have to subtract. Remember, a traded note, or let me put it this way, what you know that if there's a traded note with adjustment, you subtract the traded note. A traded note again, you subtract your traded note. Now you're on adjustments, with adjustments, if it was stated that it was not recorded, always you will add the invoice. That's what I mean. That was not recorded. Now it was on the adjustment. Additional invoice, you subtract a traded note, you add the additional invoice on your adjustment. But here now this case is different because it was an error. We are correcting an error and doing the right thing. So we were supposed to subtract it, but we didn't. So we will subtract it now and do the right thing because we have previously recorded it as an invoice. So we have to subtract it to correct that error again. So we'll subtract it double. So that's what is going to happen here. So we are going to take, let's do this now. We are calculating our trade data. The answer here is going to give us our trade data. Or you can say it will give you what? Your outstanding debtors. Your outstanding debtors. Don't mind my abbreviation, write it full. Okay, now let's get back to the cow now, to the real deal. Now let's apply, because accounting, it's a practical subject, not a theoretical subject. Now let's move to the practicality of it. So now we are looking for a trade data. Remember, when you get your trade data, is the one that you are going to multiply with that 5%. So the first step that we do, we are going to take our debtors control from our pre-adjustment. According to our pre-adjustment, our debtors control is 186,000. So we take that 186,000. We then subtract the bad debt, the new bad debt, which check if there's any bad debt. So transaction number C, if you go to transaction number C, you will see that a debtor P Marlene with an outstanding balance. This means this person was owing us 42,000, has left the country. His account is to be written off. That's your bad debt over there. This is your bad debt because his account will be written off. If a debtor is written off, that debtor is adding to our bad debt. So that's the new bad debt that we were looking for, the bad debt on adjustment. So we are going to subtract it. How much was he owing us? He was owing us 42,000. So we are to subtract the 42,000. Okay, again, after subtracting the 42,000 rand, then what else? We check in Google for the invoice and stuff, but we saw that, okay, we had that transaction over there, which means this was an invoice, was a credit note. So we were supposed to subtract it, but instead we have added it up. So now we are going to subtract it 2 times. So we are going to subtract how much now? The 99,200. Why? If this was a normal sale, we won't have done this, but because now this is not just a normal return, but it's a return by a debtor. I hope you note that, guys. So this is affecting the debtors as well. Then after doing this, there's no other transaction that is affecting our debtors. As we were reading through, we didn't see any transaction. We saw e-wages, we saw depreciation, we saw as well as share capital and dividends, but nothing about data. So we don't have to go through that again. So you simply, after getting your answer, then you multiply it with your what? With your 5%. Or you can do it step by step. You can say this, then you get your answer. You can punch this on your calculator, which is you can take your 186,000 minus 42,000 minus 99,200 minus 99,200. Then you are getting what? 44,800. 48,800. Then you take that answer, you multiply it with 5%. Shift, then you press your percentage, then you get your answer. Therefore, okay, after getting this, then now that means the next step, I will multiply this answer with what? With my 5%, which will give me what? 2,240. So it's 2,240. 2,240. So you can see now that that's why they have indicated that they have told us that our provision for bad debt is an income, because the new provision for bad debt is less than the old. So, but what are we actually going to record? We are not going to record these figures. We are going to record the difference. So we are going to look for the difference. How are we looking for the difference? We're going to take the bigger amount, which is 3,240, and subtract the smaller amount, which is 2,240. So by jongering there, you can see the difference is 1,000 rands without even punching it on your calculator. Then we add up these to the other operating, we total up the other operating incomes. So how are we going to total? It's going to be 71,500. Yeah? Punching your calculator. Then again, we look for our gross income. So how do we get gross income? We have to take your gross profit and add it to your total of your other operating income. So in this case, we are going to take the 3,030,600 rands and add the 71,500 rands. Then there it is, guys. We are done with the first part. We are having our 310, 3 million, sorry, not 300, 3,102,200 and 102,100. So remember, you can double check my answers, my calculations as well. Feel free to do that. Okay, now we are done with the income parts. So we move on to the second part, which is the expenses. Now, okay, luckily for us, even they have indicated, they have told us that, note that you are having the salaries and wages, you are having the advertisement, you are having the bad debt, you are having the packing material. And this amount they have done, the same thing that we would have done, they have given us the amount from the pre-adjustment. So the only thing that we need to do is to check for e-adjustment following this amount. The 681,600 is the figure from the pre-adjustment. Remember, this is the figure for the wages and salary. This is it, guys. They have given us that amount, 681,000. We were going to do the same thing. We're going to go to our income statement and open bracket and put right 681,600, then check for additional information. So they have saved us the trouble. So now what we need to do, we just check for additional information with respect to our salaries and wages. This is transaction number F here. If you note, there's something about the employee. So anything that is having to do with an employee, so you know by now when you are doing accounting, it will have something to do with your wages or your salaries. Okay, now let's go through it. One employee received a double salary by mistake from salary journal for February 2022. This must be reversed. The employee made a direct deposit to the business account as a return on 28 February 2022. His normal salary details are as follow. Okay, now there's this person that we have paid double. But fortunately for us, this person was a loyal employee to the company. So this person paid back the amount that he was given in advance. But to correct this on our books as well, we have to correct it to rectify it. Besides rectifying it, because we have to treat this as an in advance, as an amount that was given in advance. Are we together? Because it was an error for us to begin with. So how are we going to correct this? We have to subtract that amount. Remember, according to the business, when we record this amount, then when we record salaries, we record them we record the gross salary, not the net salary, because the gross salary is the amount that the business is liable to pay this employee. So now the deduction will be deducted on behalf of the employee by those parties that are involved to deduct the deduction, the pension fund, the pay as you earn, the government will deduct that amount from the gross salary that as a business we have given the employee. So that we have signed the contract, that we are going to give this person the gross salary. Then it's up to the government and the employee, if they are going to deduct how much. It's not for the business. And on top of that, of the gross salary, we add what we call e-contribution. Then the business also contribution to some of the deduction of the employee. So we have e-contribution. So now the amount that the business in total will give on behalf of this employee is the gross salary plus the contribution. Yeah? But in some businesses, they will separate the account for gross salary, the salaries and wages. So gross salary, in other words, is a salary and wages of the customer, of the employee. Yeah? So now what I mean, so it will depend on the sovereignty of the business. Remember, each business is having its sovereignty. So each business decide whether do we add the gross salary and the contribution on one account, or do we separate them? So now do we add them both as our salaries and wages, or do we separate them? But this will explain, or this will give us more information about the business that we are dealing with, because we are told over here that the employer's contribution are part of the salary and wages. So now they are telling us over here that they are adding them together. So they don't have separate account for a contribution. So they just, because at the end of the day, we are contributing because of this employee. So we must as well say, this is the total amount that we are taking out as a business on behalf of the salaries and wages. Okay, so the first thing that we need to do, we need to calculate the gross salary. By now, you know, to calculate the gross salary, you will always take your net salary and add back the deductions. Ne? Okay, so the gross salary of this person will be, calculate the gross salary. We will take the 15,000, will be equal to 15,000. Let me write it over here because of the space. Let me use this space available here. So I will take the 15,000, remember, and add the 2,000. I'm doing a reversal type, and add again the 3,000, which will give me what? 20,000. So the 20,000 that I'm getting, I'm going to subtract. Remember, note, this is not a wages that was omitted. So this wages was not supposed to take place in the first place. So it's an error. We are correcting that error. So we are subtracting it because it is included over here. So we are subtracting it, the 20,000 gross salary that was not supposed to take place. So again, we subtract the contribution that we have done as a business, which is 44,000 on behalf of the salary. We subtract the 4,000 as well. Then you work out the calculations. So we are going to take the 681,600 and subtract the 20,000 and subtract again the 4,000, which will give us the total of 600. Let me double check. 679,000. I made a mistake. There's okay, yeah, okay, I added a 0 there. So it's going to be 657,600. 657,600 rands. So this is the correct amount for e-wages and salaries. Okay, I hope you are together still there, guys. So I said it's 657,600, 657,600. Okay, then we move on to the advertisement. We check the advertisement. Surely there's a transaction with respect to the advertisement. We go and check any transaction with the advertisement, transaction G. Okay, as you can see, they are telling us now, advertisement of 40,000 consists of a month-to-month contract with local radio station. Advertisement was paid for 13 months. Okay, so this means this 40,000 included in that advertisement is a 40,000 that was paid for how many months? For 13 months. Okay, this is a word for. Then it doesn't end then. We are told that from 1st November 2021, the contract rate was decreased by 10%. So there's a change. That's why we need a timeline. So to account for that change, so the timeline, it will consist of 12 months. Normally, the normal timeline consists of the 12 months. So for this 40,000, so it's going to be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. But this one, because since it's an advertisement for 13 months, so this timeline will consist of 13 months. So which means the 13th month doesn't belong on this accounting period. That's what we know. Okay. So this is the month that we need to account for and subtract it. But you cannot just say, you cannot take this amount and divide it because there are other months that are involved. Are we together? So there's another change that has taken place. So we first highlight the change that have taken place. When did the change take place? So remember, let's indicate, okay, the last month of the accounting period is February. Our year ends in February. So the next month of the next accounting period, that means the next year will start in March. If this year ended in February, the next year will start in March. Mark that. So if the next year is starting in March, that means also this same year, this current year started in March. Okay? Let me explain this a little bit further. Remember, guys, if the year ends in December, automatically, you know that the next year will start in January. That means also the current year has started in January, simple. So if the next year is starting in March, that means also the current year started in March. So it's March, April, May, June, July, August, September, October, November, December, then January. Okay, note that I'm using the space in between the lines for my months, not the lines exactly. Okay, now we are told that change took place starting from November, 1st of November. So where did November started here? So changes took place from November. So this is when the change started to take place. Increase. So this change started here. It's just a highlight. So how many months that were affected by the change in this amount? Because this amount in this 40,000 is for 13 months. That is clear. So in these 13 months, how many months were affected by the change? 1, 2, 3, 4, 5. So we know that in months would change. We first identify that our months would change. If you are doing economics, you will know this sign. Months would change. There are how many months? There are 5 months with change out of 13 months. So that means the month without change, you take the 13, you subtract the 5, you will get the what? The 8. So in months with no change, there's 8 months with no change. Okay. So without using a formula, maybe we can work this out as well. So the first thing that I will do, I know in order for me to calculate, I need to get this monthly fee for advertisement after change. So if I need to get this monthly fee so that I can separate, because I want to subtract, there's only 1 month fee that is not belonging in this accounting period, since this is for 13 months. So in this 40,000, what I will do, normally I would say, okay, if I want the monthly fee, the monthly fee, remember this approach is the same approach we will use for a rent. If I want the monthly fee, what I will do, I will take the amount included, which is the amount on the pre-adjustment. The amount included in the pre-adjustment, not exact the amount. The 40,000 is the amount that is included on the pre-adjustment. Remember? Okay, is the 40,000. So I divide it normally under normal circumstances. I will divide it with the months. But now there's 2 types. Our months here are divided into 2. The total months I have to calculate for the months, total months. So the total months will be, I will divide it with TM for the total months. The total months now, we are having a month with no change, plus a month with change, affected by change. So we have to add them together. So how do you calculate a month with change? You need to include that change in those months. Okay, let's first start by calculating our total months. Total months, we are going to take what? We are going to take the 8 months with no change and add them with the month with change, which is a 5. But when we are doing that, the month we multiply with the change. So the month would change, we'll multiply them with the change. What is the change? We go back to our timeline. The change, we were told that now the advertisement decreased by 10%. So if it decreased by 10%, that means the change was in total, the change now, remember, before change, always your figure will be 100%. So after change, it decreased by 10%. Now it becomes 90%. So this is the change that we are referring to. So that means we are going to take the 5 and multiply it with 90%, which is 90 over 100 for some. Then you get your months, your total months, which will give us what? 8 multiplied by, we will say, okay, now it's 5 multiplied by 9, or you can just punch this, the whole thing on your calculator, 8 plus 5. If you are using a sharp or another calculator, type of a calculator, that means you will have to use a brackets. Yeah? So you will have to open a brackets over here and say multiply by 90 divide, because you will be using divide. If you are using sharp, divide by 100. But it's easy for you if you are not using the sharp, you will just punch it as it is. Then you will get what? 25 over 2, which you can write as a decimal if you feel like it as well. It's fine as long as it's not a long decimal. So if it's a decimal and it's a 2 decimal, so it's fine, you can write it that way. Therefore, or you can write 12,5, which will be simple for most of you guys. Okay, then this is 12,5. Our answer is 12,5. Therefore, that means we can get the monthly fee before change, with no change, in other words. So that means we can get the original price for the advertisement before the decrement. So now that means, okay, the monthly fee for advertisement before decrement is equal to what? We use the formula, the normal formula that we normally use. We take the 40,000 and divide it by 12.5, which in return will give us how much? You find your calculator again. You take the 40,000, you divide with 12.5, which will give you 3,200. Remember, good people, this 3,200 is the monthly fee with no change, né? Before change, but we are looking for a monthly fee after change, because the month that we want to get the rate of is on the yellow over here, which means it's affected by the change. So before we subtract it, we need to take the monthly fee and affect it with that change. So we are going to take 3,200 and multiply with 90%, which is 90 over 100, to affect it with the change. So which will give us how much? You punch your calculator, just simply say multiply by 90% or 90 over 100. If you are using this calculator, you can just simply say 90 shift, then percentage, then you will get your answer, which is 2,880. I hope it makes sure. So our answer will be 2,880. So this is the amount that is not belonging. This is the expense, the prepaid expense that is not belonging in this accounting period. So this is the figure that we have to subtract from included in this 40,000, and this 40,000 is included in that 60,000. So in that 60,000, we only separate, we're going to subtract the what? The 2,880. Remember, guys, this method that I have done here, you can use this method for your director's fees. You can use it for your what as well? You can use it for your rent. So this is the same method. So I have splitted it, guys, so that it will be simple, so that I won't have to use the formula. Remember, on my previous videos, I also have the formula for that, a simple formula that you can use. But I like to use this way so that you will understand it before you summarize it as a formula. Maybe next time I will use the formula. Okay, now, So let's go to the bad debts. The bad debts are 6,730. This is the amount on the pre-adjustment. You know, you take the amount from the pre-adjustment and you subtract the new bad debts. They are always simple. So the new bad debt on the adjustment. So we have our bad debt, the amount that we have written off. So we are going to, we are not subtracting it, we are adding it. Sorry about that. You add the 42,000 because this is the additional bad debt. So you simply punch your calculator again. You take 42,000 plus the 6,730, which will give us what? 48,000. 48,730. Therefore, again, we forgot to calculate this 1 hour advertisement. So to do the calculations, so we took the 60,000 and subtracted the 2,880, which gave us 57,120. So guys, now we are dealing with the packing material. Remember also the packing material, they have given us the packing material from the pre-adjustment, which is the purchased amount of the packing material. We are going to check for, did we have any packing material during the year or after? Did you have any packing material on hand in the current year? Yes, we did. Remember, you go to transaction E. I won't cycle transaction E because we only use the portion of the transaction at the moment. So I will only cycle the portion that we are going to use. So we are going to take that 6,020. We are going to subtract it because it's the packing material that has not been used. Remember, you have been taught this before, that when you are dealing with packing material, you are looking for a packing material that was used or for e-consumable stores that were used. So they are the ones that will become our expense. So we are subtracting the one that we have not used, which is 6,000. We subtract the 6,020. But again, after subtracting it, we don't end them. You check if last year or we didn't open the year with a packing material from the previous accounting period. Didn't we have an opening balance? Remember, this is the packing material that we have bought during the year. But remember, you cannot use this the new packing material without using the old packing material. So if we had an opening balance on our packing material, that means this year when we were in operation, we have used it as well. So we will start with the old one to use. So we check the old, did we have the old material balance? You go to your balance sheet session and there it is over there. And student, you will forget this. I know you guys, because in most of your exercises, it's not there. So be careful of these things, these small things. So always check if you didn't have any opening balance. There it is, packing material at 1st March 2021, which is at the beginning of this was our opening balance, which was 820 from the previous year's packing material. So also it will add on our used material. So we will add it because it's a used material, 820. Then let me double check the figure. It's 820, okay? So 820, so it's the packing material from last year that was on hand. So surely this year we used it as well. We are calculating for a packing material used. So let's do the working. So we are going to take the 15,000 and subtract your 6,020, which is the packing material on hand, then add the previous closing balance on packing material on hand, which was 820. Then we get what? 9,800 as our new packing material used. Okay, so we are done with the packing material and we are done with the expenses that they have given us. So we are going to go and check for our expenses, other expenses. So we are going to check for other expenses. There's no, yeah, it's fine either way, whether you started with the previous pay balance. So it's the same thing. Then now moving on to other expenses. Let's first take every account that we have used. So we have used the sales, we have used the cost of sales, we have used the debtors allowance, but we have not used the director's fees and the audit fees. So our director's fees here are 550,000. We need to bring them down. And while I was reading through the transaction, I didn't see anything about the director's fees. So we are going to take them as they are. The 550, which is our director's fees. So our directors fees, sorry for the writing, is 550,000. Let me double check so that I won't paraffin you guys. 550,000. And also the audit fee, there's nothing said about them. Without wasting time, we are going to take it as it is, 188,450. 410, sorry, 188,410, 410. So this is our audit fee. Okay, then now we check for the next expense. So we are done with, we tick all the expenses that we have used: directors, auditors fees, wages, rent income we have used. The interest, remember, the interest, we will deal them after the operating income. Then the advertisement we've dealt with. So the insurance is how much? 14,700, and there was nothing said about the insurance as well. So we take that 14,700 as it is. So umshwalense wethu, our insurance, it's going to be 14,700. Okay, then we go and check for another expense that we have not used. A bed that we have used. Then a packing material we have used. Sundry expenses we have not used. And the sundry expenses, there's a question mark and there was nothing said about it. So that means we are going to use it as a balancing figure, our sundry expenses. So we write our sundry expenses there. Our sundry expenses is going to be a balancing figure. Then again, we check for another expense. So we are done with the sundry for now, halfly done. Ordinary share dividends, it's no entry. We income statement. So we check for other expenses not on our pre-adjustment balance. The first expense that will come to your mind is the depreciation. You need to account as well for depreciation. Okay, for depreciation, we need to come. I need to make some few notes that you need to jot down as well. Whenever you are calculating depreciation, you know that in your depreciation you will be calculating. I would like to use, let me use Utrim to make my statement over here. Whenever you are calculating depreciation, the first thing, there's a hierarchy that we are going to do. You know that you have to calculate depreciation on two accounts. You have to calculate depreciation on two assets, which is a vehicle. and you have to calculate depreciation on another account, which is called the equipment. So there are two accounts that we have to deal with. So we have to calculate depreciation on equipment. So the equipment, so you add them up to get your what? Your total depreciation for your income statement. Yeah? For your income statement, whenever you are doing your income statement, you need to calculate these two depreciation. But now you won't get equity depreciation. It won't be given to you always. Yeah? So now we have to calculate these two depreciation. Whenever this is the general, this is what I do whenever I'm calculating for each depreciation in each account, whether it's vehicle or equipment. I will always calculate for depreciation number one. Then to get my depreciation, I use this method, depreciation number one, depreciation number two, depreciation number three. Nice. Remember, this is the method I learned from my high school teacher, and I've been using it even in university. I've been using it as a teacher. I'm still using it. So it's one of the methods that were working for me. Maybe it will work for you too. Okay, what do I mean about depreciation number one? Depreciation number one is the depreciation. We'll calculate depreciation on the old asset. So what do we mean about that? We mean on those assets that have stayed in the business for more than 12 months. In other words, the old asset we had in the business are the asset that we started the year with and ended the year with. So they have stayed for the whole 12 months. So these are the old assets in the business. Then we move to depreciation number two. What do we mean about depreciation number two? I will calculate my depreciation on the additional asset in the business. So the new asset, in other words, the new asset. So the asset bought during the year, the purchased asset during the year. So what about depreciation number three? Depreciation number three, I will calculate depreciation number three on the disposed asset, the depreciation for the disposed asset. Or should I say the sold asset during the year. So these are my depreciations. But remember, since we know that depreciation can be calculated on diminishing balance method or carrying value method, or it can be calculated on cost method So these are the other things that you need to know. So that means if it's calculated on diminishing balance method, that means before you calculate your depreciation, you have to take your cost price and subtract your what? Your accumulated depreciation before multiplying with the what? The depreciation percentage. Okay? So this is the, let me rub this out. This is the diminishing balance method or the cost method, but or the carrying value method. But when the depreciation is calculated at cost, now, if the depreciation is calculated at cost, the formula will be, we will take the depreciation will be equal to, in this method, we will take the cost price and simply multiply with the what? With the percentage. But now there's something that you need to note when you are calculating the depreciation on cost price. When you are calculating the depreciation on cost price, you need to note this. Yeah? You need to first calculate. Yeah? You need to first calculate what? Let me not write first calculate. You need to first calculate the what? The carrying value of the asset, because you need to compare the depreciation with the carrying value of the asset. You need to make sure that the carrying value of the asset, that asset is greater than the depreciation you are calculating. So what do I mean by this now? We need to make sure at all times, if I'm using a cost price method, so I need to make sure at all times that the carrying value of the asset that I'm dealing with is greater than the current depreciation. So what do I mean by that? So the first thing before I calculate my depreciation, I will calculate the carrying value of that asset. Remember, any asset at the end of the day, there's no asset that can be fully depreciated and have no value. If it was a car, you bought a car for 200,000. Let's make an example. You bought a car for 200,000 rands. And in this car that you bought, this is the cost price of the car. You bought it for 200,000 rand. Okay, now the cost price of the car is 200,000 rand. Okay, we are happy with that. And during this year, we are to calculate the accumulated depreciation for this car. But we find out that, okay, now the accumulated depreciation, we are to calculate the depreciation for the year for this car. Okay, we assume that it stayed for the whole year. Okay, the accumulated depreciation at the beginning of the year, we are given that the accumulated depreciation at the beginning of the year was 185,000 rands. So this is the accumulated depreciation that the car had at the beginning of the year. So now we are told now to calculate the depreciation for this year, which is now this car. We are calculating the depreciation for this car, and we are told that depreciation is calculated is equivalent to what? To 10%. It's calculated at 10% per annum. Okay, so now the depreciation is calculated at 10% per annum. So what I'm saying at cost, we're using the cost method, is calculated at cost or on straight line method. So what I'm saying to you now, I'm saying that the first thing before you actually calculate the depreciation, you first calculate the carrying value. Just and put it aside. So, okay, you first check the carrying value of the asset. The carrying value of the asset is how do you get the carrying value? Take the 200,000 and minus the 185,000. 185,000. Which will give us what? Then you punch your calculator. But by joining there, you can see your answer will be 15,000, 200,000 minus 185,000, which is giving us 15,000. So now the value of this asset is 15,000. So there's no way that this asset can depreciate more than 15,000. That won't make sure, guys. Remember, even if it's a car, it's fully depreciated. But at the end of the day, in reality, that car is having a value because I can take that car, that body, and take it to the scrapyard, and I will have a value for that car. So it's still having a value, even if it's not moving, it's not working, it's standing there, but it's still having a value at the end of the day. So we will use a method now. If we are going to calculate now our depreciation, should our depreciation be above this carrying value, we will use the method called the 1 rand residual value method. The 1 rand carrying value method that now whenever, if the asset is fully depreciated, we need to make sure that it's having a carrying value of 1 rand. Okay, but I will show you how do we do that as well. So now we calculate the depreciation. We are going to take a cost price, 200,000, multiply by what? By 10%, which will give us what? 20,000. Then you compare this by joining here, you can see that the depreciation is greater than the carrying value, and that can't be good, people. We said it. Ne? So now we need to correct this. So because the depreciation now is greater than the carrying value, so we are going to use the 1 rand carrying value method. So that means our depreciation now, we will calculate the depreciation using this method. This method states that you take your carrying value and you simply subtract the R1. Always take your depreciation and subtract your R1 to get your depreciation. This is how we are going to calculate the depreciation on this. We want to use this one, the 20,000, because the depreciation cannot be greater than this. So that means the depreciation for this asset now will be 15,000 minus R1, which will give us 14,999 rand. So this is the depreciation for this asset. Please note this, guys. Note this. Note this. I know whenever you are calculating depreciation on cost, whenever you are calculating depreciation on cost, note this. Note that your carrying value must always be greater than your depreciation. If your carrying value is less than your depreciation, you will use this method to calculate your depreciation. I hope it's clear, that part. Okay, now let's go back to my depreciation number 1, depreciation number 2, depreciation number 3. Okay, whether you are calculating depreciation, because the depreciation will depend whether you are calculating it on depreciation number 1, depreciation number 2, depreciation number 2. Okay, so what I meant about this depreciation number 1, depreciation number 2, depreciation number 3, we are calculating depreciation on the old asset. I normally start at the back and do a reversal. It's easier that way, because it will be easier. You'll be given information for depreciation for the asset disposed, and you'll be given information for what? For the asset that has the new asset as well. So it will be easier. But now here is the trickiest part now, to calculate for old. Yeah? So now let's say if you are calculating for old, remember you will need the cost either way when you are calculating the depreciation. Whether you are calculating it using the diminishing or the what, you will need the cost. So the cost for old, given what? Given, so now we are calculating the cost for old. The cost for the old, given what? Given the balance. Given the balance at the what? At back, at the beginning. So if you are given the balance at the beginning, remember the cost price that will be given on your pre-adjustment will be at the end, unless stated that the other information was not recorded. But the only cost that you will be given, that will be at the beginning, will be the cost for the accumulated depreciation only. Okay. So remember, let's say if you are using the diminishing balance method or the carrying value method to calculate depreciation, so mark that as well. So now we are saying that we are going to take, we're going to need the cost price. So to get our cost price, what we are going to do, we are going to take the cost price first. We are going to take the cost that we are given at back, and we are going to to subtract the sold or the disposed asset. Yeah? But we are subtracting what? The cost price of the disposed asset to get the cost at the cost for old. So which means we want the cost price for those assets that we didn't sell during the year. Remember, in the cost price at the beginning, the asset that we sold during the year are included there, because we started the year with and we decided to sell them during the year. That's why we are separating. So they are not qualifying to be part of the old asset. And also, since we are doing the diminishing balance method, we'll have also to calculate for the accumulated depreciation. So it will be the same procedure, guys. You are going to take the accumulated depreciation at the beginning. The only difference is that we are calculating for accumulated depreciation. The accumulated depreciation at what? At back. Then you subtract the accumulated depreciation at back. for the disposed asset. You will be given information. Don't worry, don't panic. You will be given that information. So let's check in what if we are given the balances at the end. Yeah? The balances at the end, if we are given the balances at the end and we are looking for the diminishing, because it's only the diminishing balance method that we'll be using. Most of you is not only the diminishing, but is the diminishing balance method that will find the problem, because the cost price is the same whether it's diminishing, it's the cost price, you will use the same method. Yeah? So now let's say again we are still using on the diminishing balance method. Yeah? We are checking the diminishing balance method, but if we are given now the cost, given the balances at the end, which is from your pre-adjustment. But the balance that you will be getting at the end, if it's the balance that you'll be getting, you will be, for this case, the balances at the end, to calculate your cost price, you will take the cost for old will now be equal to the cost at the end minus the addition, but the cost price of the addition. The cost at the addition at cost. So this is how we are going to do it. To calculate the accumulated depreciation, should you need it, if you are given the accumulated depreciation at the end as well, of which that's rare, accumulated depreciation of the old again, because you will need it. So to calculate the accumulated depreciation, but simply because you may not need the accumulated depreciation to calculate, but let's do it anyway. As much as this, you may not need it, because remember, you will always, in your pre-adjustment, you will always be given the accumulated depreciation at the beginning, unless they have calculated. So if they have calculated the depreciation, there will be no need for you to calculate the depreciation if they have given you the accumulated depreciation at the end, because they have calculated the depreciation already. So the depreciation is already included. Okay, so, but yeah, that's okay. So to calculate the accumulated depreciation as well, we are going to do the same thing. We are going to take the accumulated depreciation, at the end, and subtract what now? The accumulated depreciation, the depreciation in other words, because this is just the depreciation number 2, or the depreciation on addition, for the additional asset. Simple. Okay, with these notes, okay, guys, we can go to our question, please. I hope you were taking notes. You were taking them down, you were jotting them down, because they will work for you whenever you are dealing with your calculation. Use them, use them. Learn to use your notes, guys. Whenever you're answering a question, learn to use your notes so that you will be able to work without them in the future. Okay, that will train you. Okay, now getting back to the cow, we were to calculate our depreciation. Now we are told that make provision for depreciation transaction. We have to use transaction H. Transaction H, because this transaction H, we are given that depreciation on vehicle is at 15% per annum on cost. So since now the vehicle is calculated on cost, the first thing that you think of, you go and check your booking. It's 15% at cost. Then you check your balance, your cost price, the cost price at the end of the vehicle. Remember, there's no vehicle that was sold. Nothing is said about any vehicle that was sold, but the only thing that is said is about an equipment, a computer that was purchased. Okay, so we have no vehicle that was sold. We have no vehicle that was bought, so we don't need to calculate depreciation number 3 and depreciation number 2. We will only calculate depreciation number 1. So there was no movement on our assets. So we go and check our balances. Okay. So we are given here the cost price for the vehicle is what? Is 800,000 rands. And the carrying value is what? Is 680,000. So I will subtract the carrying value, not the carrying value, the accumulated depreciation, because I want to check the carrying value that I will compare with after getting my depreciation. So it's 800,000, the cost price, minus, guys, minus 680,000, which will give me what? Which will give me 120 by Jongaring. You can punch your calculator to prove that. So it's 120. So now we are getting 120 because it's 680, not 68, 680,000. So this is the carrying value that we will compare with the depreciation that we'll get. Remember, our cost price is 800,000. So let's go and calculate our cost, our depreciation, and use the percentage provided for us. So to calculate our depreciation, we are going to take the 800,000 multiplied by, remember that our depreciation is calculated at cost. We are going to take 800,000 and multiply the 800,000 with the percentage, which is 15% at cost. So with 15%, then you punch your calculator to calculate your percentage again. Punch your calculator, you are going to take the 800,000, multiply it with 15%, which in return is giving us, it's giving us 120,000 again. So you not again, it's giving us 120,000. Okay, now the depreciation is the same as the carrying value, because remember when we are calculating carrying value there, we got 120,000. So the depreciation is the same as the carrying value. Can we use it? No. So if the depreciation is greater than the carrying value or is equal to the carrying value, you use that R1 method. So therefore, our depreciation for the vehicle will be what? Will be 120, which is the carrying value. Then you subtract the R1, which will give us what? 102, is it 199,999? Let's double check that. If is it 190? So it's 120,000 minus R1. So, or it's 119,000, sorry. 119,000. So therefore, the first depreciation that we have calculated, we put it down, it's 119,999 rands. Okay, then we move on. Remember, we said when we are calculating depreciation, we have to calculate depreciation for a vehicle and for equipment as well. Then we move to equipment. Equipment at 10% on diminishing balance method. So which means the carrying value. So you don't need to calculate the carrying value here, because this is not at cost. Remember, this R1 method, we use it only when depreciation is calculated at cost. Maybe some other day I will explain why is it so. Okay, now moving on to the this 10% diminishing balance method. And remember, we had a new equipment. I said we calculated depreciation number 1 in each asset, depreciation number 1, depreciation number 2, Depreciation number 3. Depreciation number 3 is on the salt. We don't have the salt, so we don't have to calculate the depreciation number 3 on equipment, but we do have the addition. So it's easier for us if we will start with calculating for that additional asset, although it's a diminishing balance method. By now, we know diminishing balance method will take a cost price and subtract the accumulated depreciation before we multiply with the percentage. So we will do that exactly. We'll take a cost price of the new equipment, which was 60,000. Remember, it was given to us 60,000 rands. Then we take that cost price, which is 60,000 rand. Take the 60,000 rand and minus the accumulated depreciation. Remember, this asset is new, so the accumulated is still 0. Then after minusing your 0, then you multiply with the percentage given to you, which is 10. But now, since this asset has not been in the business for the whole year, we check when did we buy this asset. So this asset was bought on 1st June. So we check for June on our accounting equation, on our accounting period, sorry. So now on our accounting period, we check for June. When is June? It's March, April, May, June. So we bought this account with this what? This equipment on June. So how many months did it stay? Don't forget, this doesn't belong here. This doesn't belong here. Our accounting period ends in February, not in March. Okay, now moving back to the cow. Now you can see how many months did this car stayed in the business. Eh? So it was supposed to stay for 12 months, but it didn't stay. We bought it after 3 months. So you can separate the 3 months from 12, you will get 9, or you can calculate it manually and see you will get 9. So by joining there, we can see that this asset stayed with us in the business for 9 months. So we are going to multiply with the month out of the total months of the year. So you punch that in your calculator as well. So it's going to be 60,000 minus 0. So 60,000 minus 0 still is 60,000. So hence I'm not minusing it there. But for the sake of, for argument's sake, let me minus that 0. So for you to see it, then I multiply with the 10%, shift percentage. Then I multiply with the 9 over 12 as well. Then I'm getting what? I'm getting 4,500. So the 4,500 that I'm getting is the depreciation for the additional asset. So since it's the depreciation, it's one of the depreciation for equipment. So I will add it. So I will add the 4,500 rands on top of it. Okay. Then that means now I'm left to calculate depreciation for depreciation number 1. Okay. When you read this transaction over here, listen to it very carefully. Read it very carefully. They are saying, note that a new computer was purchased on credit on 1st June 2021 for 60,000. This has already been recorded. So that means the cost price is already recorded. What is not recorded is the depreciation, because they have not calculated for depreciation for this year. So now, which means in this cost price that you see, remember, this is the trial balance. We do the trial balance at the end of the year before even calculating for depreciation. So the land, the equipment that you see, which is 200,000, in this equipment is included there is the 60,000 in that cost price is the 60,000. for the new equipment. So what we are going to do when we are calculating old, remember I said you will subtract the what? We will subtract the cost price of the old equipment. So now that means we'll first calculate the cost of the new equipment. The cost, this is the cost at the end, remember? So we are looking for our cost of this old equipment. So what we are going to do, we are going to take the 200,000 rands and subtract the what? The 60,000 rands to get the cost only for the old equipment, which will be what? 140,000. So after getting the 140,000, what we are going to do, then because if depreciation on equipment, remember, it's calculated on diminishing balance method, we are going to subtract the accumulated depreciation, which is 37,000. After doing that as well, then we multiply by the percentage, which is 10%. Then we get the depreciation for the year. We don't have to multiply by months out of 12. This and the old asset they have stayed in the business for the whole year. Then you simply punch your calculator. So when you are punching calculator, you're going to take your 140, open your brackets, 140,000. You minus 37,000. Close your bracket. Then you multiply it with 10. Percent shift percentage. So you will get what? You will get 103,000. No? 10,300. So it's 10,300. 10,300. So this is the amount that we are getting, guys. 10,300 is the depreciation for depreciation number 1. So we go and add it there as well, because it's a depreciation for our equipment as well. So we add it 10,300. Okay, some of you guys would have added these two depreciation because they are for the equipment, both of them, then bring the total here. The risk of doing that is that what if one of this depreciation you calculated it wrong and one you calculated it correct? So you will bring an incorrect answer here. So you won't have a mark for the correct one because we didn't see the calculations for it. So that's the risk of it. So that's why I separate them. So I add all of this depreciation, 119,000. The 119,000, was it 100? Yeah. 119,000, sorry. 119,999 plus 4,500 plus 10,300, which will give me what? I'm getting 134,799. 134,700. $799. Okay, I'm sorry for the delay on my pen. It's writing slowly. Okay. Now then, lastly, remember, there's no asset that was sold, so we don't have to calculate for a loss on sale of the asset. And also our provision for bad debt is an income, so we don't have to worry ourselves with that as well. Now the third thing that we need to check is the trading stock deficit. Since there was no space on the income, so we already know that we are having a trading stock deficit, not a surplus. Okay, I will abbreviate because of the space. How do you calculate the trading stock deficit? You take your trading stock from your pre-adjustment trial balance we move and check it. How much is our trading stock on our pre-adjustment trial balance? The trading stock is 1,050,300 rands. So it's 1,050,300 rands. Then the next thing that we do, you subtract the trading stock on hand. This is our trading stock on hand, 1,002,000. To subtract the 1,000,000 and 1,002,000 rands. Then you check for any transaction that will affect our trading stock. Remember, if we have previously found a transaction that was affecting the sales, what are we selling as a business? We are selling the trading stock. So that means automatically the trading stock is also affected. Are we together? But now the same amount, remember, if there's a positive, that transaction is affecting the sales rate to positive. If the sales are increasing, you have to take note. If the sales are increasing, that means the trading stock is decreasing because we are selling the trading stock. So if the sales are increasing, the trading stock is affected negatively. If the sales are affected positively, the trading stock is affected negatively. The same way, but we remember the jigsaw puzzle is that you don't record the trading stock at selling price, you record them at cost price. That's the only thing that you. So now remember, we had a transaction that was affecting here the what? The sales negative, which was negative 99,200, the selling price, with selling price of 99,000 total selling price. So we are going to take that figure and calculate for a cost of their cost price, not the selling price. And it's going to affect in an opposite way. The what? The trading stock. So what do I mean by that? If it was affecting the sales negatively, so the trading stock is affected positively. But the only thing we are going to change is we are looking for the cost price of it, not the selling price. So the 99,200. So to explain this a little bit further, remember, we previously recorded someone's return as if he was buying. So we previously recorded as if we were taking out stock from the business, but actually he was returning the stock. So our trading stock was increasing, but we previously recorded it as if our trading stock was being decreased. So we have to correct that error by adding back that stock that we previously recorded it in error as if it was decreasing our trading stock, and do the right thing and add again the stock that he was retaining. So that's why it's double. So we multiply this by 100 over 160. That is the way to get your what? Your cost price. When you are having a markup, you are using a markup again. So let's get to it. So now we are saying we are going to take the 9,200 and multiply it with 100 over 160, which will give us 662,000. So what are we going to do? We are going to add back that 62,000 because our trading stock is increasing. 62,000. So the amount that we are going to get there will be our trading stock deficit. There's no other transaction that will affect the trading stock. Okay, minus 1,002,000. Again, we add Gemobu on top the 62,000 rand, which is giving us 110,300. 110,300. Remember, guys, you can always double check my answers, double check my calculations, as I may make a mistake. Okay, must say operating profit. Operating profit, now remember, we had sundry expenses, and the sundry expenses we said we are going to balance, use them as our balancing figure. So remember this, we check information with respect of these following. Yeah, we check the given information. Now, which means we will start our calculation from the bottom now. Yeah. Let's go and check for information. We're given information about income tax or something. So let's check it out. Remember, there it is. We were told that starting from the bottom, we were told we are given information for two. We're given that the operating profit is equivalent to 15% of the turnover. What is a turnover? These are sales, guys. So now, if we know that operating profit is equivalent to 15%, and as well, we know that the income tax